for joining us. On today's program, we've got Junbei Liu of 10Cap. Now, I'm going to ask Junbei Liu how she's playing Trump, but also what does she do to actually decide when she likes a company or doesn't like a company? Get inside the head of a great investor in Junbei Liu. And then we're going to talk to Grady Wolf. Now, she's from Bell Direct, and I've got a number of questions for her, how she thinks we should be playing Trump, questions around CSL, what in the hell's going on there, and a whole lot of growth and defensive stocks that she likes. And then we'll be joined by Paul Rickard of the Switzer report. Now, Paul has looked at the super tax, but I'm also going to ask him about the bond market. The bond market is what really can force Donald Trump to behave. And at the moment, the bond market is saying to him, Donald, you better behave. So let's just see what Paul's seeing there with the bond market. So without any further ado, let's kick off with Junbei Liu of 10Cap.
Thank you for having me, Peter.
All right, now, Junbei Liu, I'm going to ask you about how you're playing your fund with the Trump U-turn. Like, most of us are really happy that he de-escalated all the concerns, and then he re-escalated it with his European thing, and you're probably in Europe when he did it.
That's right.
Did you use the F word when you? No, you wouldn't do that. But did you think, why is he doing this?
Look, absolutely. But look, ultimately, I think when we run portfolio is very different from what I think he should do and shouldn't do. Portfolio is about capital preservation when times of uncertainty, and also work out what is uncertainty, what we know, what we don't know. Yeah. So should the opportunity present, we'll take advantage of it. So whatever he does, actually in a way creates more volatility. It's good for us because, you know, looking at some of the companies we bought post the Liberation Day, share price up, some of them up 60%, incredible return opportunity. So in a way it's good, but it's just in the time, this is a time where you do need to be a bit more pragmatic. You made your money, take some profit, then move on to the next opportunity, and try not to be too skewed one way or another.
Well, on this program, you indicated that you weren't afraid of the market side. You thought it was a buying opportunity, and I thought, no, that's Junbei Liu just being a tough girl, But yeah, and I guess sometimes you can get it wrong. But it's been a long time since we have got it wrong. I've been a big supporter of buying the dip. I wasn't quite sure about the last one. But I guess are you thinking to yourself, there has to be a lot of other bad things going on before you won't be so courageous to buy the next dip?
Yeah, so look at, in a way, I actually don't think there will be a big sell-off coming. No. I actually think the market will just grind higher because it just doesn't look like there's that significant news. Okay, tariff outcome negotiation come out worse than expected. That's not the surprise like before. You know, before we didn't know there was going to be tariff that significant, right? So, you know, so I think at the next level of down news on significantly down or significantly up is not there. So the next news flow is actually, we're thinking, just be a bit more cautious of the data that's coming through now. You know, we're already seeing some US companies downgrade earnings, and it's about to be, you know, there's uncertainty, there's not that much trade.
It's going to hurt someone.
It's going to hurt someone. So I was just in Hong Kong last week, and you know, overall investor base out of that China base there is a bit cautious because even though right now there's a 90-day gap, but there's still 30% tariff. So you know, it's still going to hurt someone. And right now you're seeing the economic data still okay because the pull forward. So in 90 days, many believe there won't be significant outcome because there's too many things to discuss, too different. So and then many expect China growth rate to slow down in the second half of this year significantly. Just simply because the trade is a big deal. So, you know, so I think it's just, this is an environment where we kind of just want to be, you know, we want to follow the data, follow the earnings. Stop pick becomes very important. You know, find companies that earnings doesn't get impacted, earnings still doing well. You know, and there's a few names we'll talk to, and this is what you stick to.
Yeah. I was thinking to myself, okay, let's look at one of the big stories that spooked the market. One was he's threatening Apple with a 25% tariff unless they start making iPhones in America. And then I heard a guy called Dan Ives, who's a bit of an Apple watcher, saying, well, they could take an iPhone from $1,000 US to $3,500, right? Now, that seems really hard. But I then thought, well, hang on. how do young people buy iPhones? Usually using buy now, pay later companies.
Mm-mm.
This could be good for those
Yeah, that's
companies.
right, that's right. Yeah, there's they're exactly right. So
Yeah.
so much permutations and how does it work? And plus, also in a way, you talk to Zip, their
Yeah.
customer category. They operate in the lower tier
Yeah.
customers where they actually are already the ones that they don't want to well, they can't get the bigger loans and the like, and they use the buy now, pay later.
Yeah.
So increasingly, it's actually seeing pick up in momentum in those customers. So does that mean when the economy slows down, these companies actually does so well?
Yeah.
But there's just a lot of different permutations. So we just got to be cautious
Yeah.
as we move
And
forward.
also interest rates fall, and these companies borrow money too.
That's right.
Do
That's
you
right.
like Zip at this
I
point?
do like Zip. I
Yeah.
think it's
I
Zip.
thought you were saying you
Yeah,
to say
yeah.
that.
No, no, I do like Zip. But my view is that it's done really well.
Yeah.
So I'm just a little bit cautious in this little
Yeah, me
environment.
too.
Yeah.
Me too.
Mm.
And we bought it at 40 cents, so I'm really happy that that's
You're done
doing
really
well.
well.
But
Yeah, yeah.
once it was $12 when
That's
we had
right.
it
Yeah,
as
yeah, yeah.
well.
That's
We
right.
lost that time.
Yeah, yeah.
All right, so that's how you look at the market.
Mm,
Um, and I think you've also explained that you look at the fundamentals of a company
mm.
and you like to think, do you like to, obviously you'd like to buy a company that's going to be totally Trump unrelated. No matter
Mm,
what Trump does, if you're holding a company that's going to do well, is
mm.
there one company in your portfolio that you can think of which is totally will not be affected by Trump no matter what?
Oh wow. Okay.
That's a tough
That's
question.
actually
I'm
hard
still
because
giving you
it
notice, but
there's actually
like Woolworths will be one, but you don't have Woolworths in
oh,
your
I
portfolio.
see. It's almost on the defensive side, isn't it?
Really?
Yeah,
Yeah, I
the
guess so.
defensive side. So I think, okay, won't be impacted. Look, I think domestically, JB Hi-Fi is the one that I will put my money in.
Despite it's $105 now,
It
isn't it?
doesn't matter. A rate cut cycle started,
I
two rate cut
know, I
down.
know, I
And
know.
guess what? Most of the retailers experiencing a bit of soft patch. JB Hi-Fi is not,
No, I
which
know.
is quite incredible.
Yeah,
Okay,
yeah, well, because young people go there and young people just don't care about the economy.
exactly. You got all these
Love it,
game
young people.
consoles. Exactly. They just spend their grandparents' money and or their parents' money. So, so I think the domestically focused companies all fine.
Yeah.
But I also think growth companies, you should find some of those growth companies
Mm.
hasn't re-rated. Many
Yeah.
have, like 360 and
Yeah.
everything done really well. But the ones that hasn't been re-rated,
The one that comes to mind straight away.
yes.
Good. Yes.
Wise Tech.
WiseTech.
Yeah,
Yeah.
they just made this big acquisition
Yeah. You
today.
like
I really like it.
it?
I
Share
think
price up to that?
it's only up 5%, which
Okay.
is nothing because
Nothing.
if you look at so far this year, Zero's up 30%, Life 360 last 2 weeks, not 2 weeks, last 3 weeks, up 60%. And this one's down, still down something like 15%
Yeah.
so far this year because of the issues and everything else. It is not a company you put all your, your investments in, but
a good speculation.
I think it's a good spec. I think this acquisition is good. They're taking it on debt to buy that because debt costs less because it's a very expensive and it's very creative. Debt year one, not including synergy, massive creative. And share price lagged. I think this looks very good.
Okay. I'm asking this question, and I'll probably ask you every time I see you. It's not Tyro. It's CSL. For those people who've got CSL, do they hang on and wait for the company to eventually say, hey, we're on top of all our problems? The market was probably too negative on us. What do you think on CSL?
I think when the tariff outcome comes through, we think there's probably 70% likelihood they will be exempt, in terms of a tariff for the
70% is not bad.
Yeah, so 70%, it's pretty high. So I think once that comes through, you'll have a pop of at least 10%, just that relief. Everything else just going to, look, the company will meet their expectations, I think, just scraping through. There's no big outperformance in terms of the earnings. It's just that will give it, I think it's not very far away now. In terms of exemption, that's probably 10%.
All right.
In it.
I did talk about you maybe using the F word, what Trump had decided, but did you use the Yahoo word when you heard about Trump's view on nuclear? Because Boss Energy has been one of the stocks.
That's right. That's right. Yeah.
Has it had a good day today?
Yeah, absolutely.
I
Had a
bet you
wonderful
has.
day. Oh, yeah. So I think it's well that's it. These companies are being, really long suffering. Well, given what's happening, and I think it's finally some good news.
Okay.
Yeah.
So our call that Paladin and Boss Energy look like pretty good plays when the price was down. We get a tick for that. One last one is lithium. Now, in 5 years' time, I reckon we're all going to be driving electric vehicles, apart from the people who've got gas guzzlers or great Ferraris who will never give them up. All right. So are lithium prices, is that the good companies? Are they the buy for the future, but you might have to wait a couple of years before you get the payoff? But one day the short sellers will get caught out. They're going to have to sell off. There'll be a short squeeze. Is this good thinking or bad thinking?
Look, I do think it's good thinking. You do need to take a bit longer because the price just keeps falling.
I
I
know.
don't know why. Some saying the reason it's been falling is because the CATL just listed in China. It's a big battery maker.
Yeah.
And then they were the one that flooding the market, with some of lithium just to drive price lower. So they look good in terms of their financial forecast.
Gee,
But
would a Chinese company do something like that?
oh yeah, well I can't imagine. But look, come from Hong Kong, you just hear all these stories,
Yeah,
and
right.
but the thing is, we just don't know why prices keeps going lower.
Yeah,
But the large names like PLS
yeah.
and the others had a lot of cash, right?
Which is good for a mining
Oh, it's
company.
fantastic,
Yeah.
yeah. And it doesn't look like they're going out to buy things.
Yeah.
And they said
Would
they
you
were
say
looking.
PLS is Pilbara for those people?
Pilbara, yeah, sorry, Pilbara.
Yeah.
Yeah, and then they're talking about potentially for capital return. But of course, they want to see price stabilize before they pay back
Yeah.
capital, right? There's a lot of capital to come back. So I think they look very, very cheap at this stage.
Okay.
Mm.
Yeah. And I think that there is a bit of a negativity towards electric vehicles because of fire issues, not enough charging stations, all those sorts of things. But look, the success of BYD is very interesting, isn't it? And I personally, I think I'd rather a Tesla than a BYD.
Yeah.
But I think BYD's price point is going to be great for a big market.
And the battery charging is 5 minutes now.
Yeah.
For 500 miles or something. It's incredibly fast.
Yeah.
So I think that looks really, really exciting. Only one caveat is that the in the Shanghai Auto Show, they did talk about this alternative saline technology.
Yeah.
The saline sort of battery.
Yeah.
But look, so far it doesn't show the consistency and the power. So maybe for buses instead of for cars. But look, it does look very good value.
Okay, great stuff. That's Junbei Liu of 10Cap. And that's Junbei Liu of 10Cap. Now, coming up is Grady Wolf from Bill Direct. And I've got a lot of questions around the Trump anxiety on the market and what stock she likes right now. So let's cross to Grady Wolf. Welcome to the show, Grady.
Thanks so much for having me, Pete.
Okay, so let's just run through some of the big issues that a lot of investors will be thinking about. And the first one, of course, is playing Donald Trump. On the weekend for the Switzer report, I said he's gone from being the de-escalator to the re-escalator when it comes to anxiety on the market. So how do you think investors should be playing the new and unimproved Donald Trump?
I think at the moment it's just a roller coaster. If you're on the right of Donald Trump, you got to strap yourself in. There's a loop to loop coming, there's an up and down, there's even a backwards coming at all times. So there's no way in reading Donald Trump. So playing it safe and playing your investment strategy is the best way to weather the storm right now. It is so unpredictable. On the weekend, on Saturday night, he announces 50% tariffs on the EU flat. By Monday this morning, I wake up and he's already put them on pause until July. We never know what's coming. And for investors, that's really difficult to forecast anything or predict anything. So the best way to navigate it is through diversification, ensuring that you have enough risk as well as enough stability and enough growth and enough income stocks to kind of have a really good level of diversification. And also ensuring that you're doing your research before looking at any investments to see whether they are directly impacted by Donald Trump or not. Because if they're not, then you're completely out of the storm. You're not on the roller coaster at all. And then obviously sticking to your investment goals. A lot of people are out there for growth investments or income investments. So just being sure to stick to your goals and not hitting the panic sell button, which a lot of investors are right now. That's probably the best way to weather the Donald Trump storm.
Yeah. I did like Anthony Scaramucci's take on Donald Trump. He said the taco theory is the way to play Donald Trump. Taco standing for Trump always chickens out.
Yeah, I love it.
Yeah, I think I'm really hoping he's absolutely right on that. But we have seen that pattern. Plays hard, then backs away.
Yeah.
And I do think he was taught a valuable lesson from both the stock market first, but particularly the bond market. That's when we saw him really chicken out. So let's keep our fingers crossed on that one.
Exactly.
All right, so do you think going for growth then is risky, or is it basically a sensible play if that's your risk appetite?
Yeah, it depends on your investment goals. Now, growth, there are across the board right now, we are seeing valuations are elevated, but there are still companies that are underperforming the valuations of the average sector. So, for example, you look at certain companies in the healthcare space, some of them are on an average PE of 200 times plus, but they still have a buy rating on them. And so, just looking at the opportunity, looking at the growth outlook, looking how the company is funded right now, whether they're close to profitability, especially in the growth space, you want to see that they're close to profitability. They don't have a high debt level. They have growing earnings, growing presence, and they obviously have addressed whether they're impacted by tariffs or not, and the extent of the impact of tariffs. So I think growth at the moment, while it is risky to invest in growth, we are seeing the drive of AI and this AI revolution still continuing to underpin the market growth. So I don't think that's going anywhere anytime soon. So I think investors with a growth appetite or even wanting diversification into the growth sector can't really go wrong right now because AI is not going anywhere.
Okay. All right. So I totally agree with that brilliant answer of yours, Grady. But
Thank you.
the tough bit for our listeners that we expect of you and viewers is to
Yeah.
say to you, well, give me some names. Name some
Okay.
names.
Yeah, so Drone Shield is one that we're quite bullish on at the moment.
Mm.
It's a leader in the defense space. It has the counter drone technology. So if you want exposure to not only tech but also the drone defense space, which a lot of countries are increasing their spend on, Drone Shield's an option for you because they keep seeing they're coming out with all these government contracts. As we know, government contracts are quite secure. So if you're in the space for contracts, whether you're an engineering company or you're a tech company, having a government contract is very good because you know stability, you know that they're going to pay up, and you know it's a sign of what the spend is for the government right now, and their focus is. So with heightening geopolitical tensions around the world, we're seeing a lot of demand for the counter drone technology that Drone Shield does offer. So we're definitely seeing some growth opportunity for Drone Shield, and we're quite bullish on the outlook for them. So that's a buy rating at the moment with Bells. WiseTech Global is another one that we've been obviously had a bit of turbulence last year, but
Mhm.
looking at the fundamentals of the company, it is a fantastic company. It's one of the leaders, if not the leader in the logistics space in the world. We saw it really rise to the top during COVID, and it's a company that any competitor on the horizon, it literally acquires them. And they've announced another acquisition just today. So I think it's their biggest one ever announced today. Yeah, let me just work that one out. Yeah, it's a $3.25 billion acquisition today of a Texas-based E2 Open. So they're really expanding their horizon. They're going from strength to strength. They've got a really, really tight-knit model and business model, and their CargoWise product is second to none. So WiseTech Global is one that we're really bullish on at the moment. We think it's really undervalued, and that's a high growth opportunity for you going into the future and a leader in the space. And then Life 360 is another one we have been quite bullish on for a while now. Life 360, it's gone against the odds, and it's turned what is a simple geolocation tracking service into a profitable and monetized system and a whole product that expands from just tracking people to luggage tracking to home insurance to home security, roadside safety, pet tracking, and that's all revenue streams that they've been able to monetize. So it's a company that we've been watching for a little while now, and we think the only way is up for Life 360.
Yeah. It's an interesting company, isn't it?
It is, yeah.
Because this business is primarily American, and I
Yeah,
know that they're going into other markets. And you're right. A lot of it was driven by the fact that parents were scared that what are their kids up to, and
exactly. They're going
uh,
to Macca's or school.
yeah, yeah. But it just seemed to me the kind of services product that could go in any country, and they are operating in Australia as well, and I
Yeah.
guess overseas. So there does seem to be a lot of potential there. One last thing before we get into defensives is
Yeah.
um, buy now, pay later companies. I'm kind of conflicted here.
Yeah.
About a few months ago, a firm in the US reported really well. Then we saw Afterpay and Zip do well. And then only last week, I think Klarna had a pretty bad report. And I'm wondering if that's specifically a problem for Klarna
hmm
or is it a buy now, pay later and payments company problem?
I see that like buy now, pay later were the market darlings during the pandemic because everyone wanted to buy things now and obviously pay later as the name goes. But to be honest, I've never used one myself. And I know that these companies make a lot of their profits out of people not being able to pay their debts back.
Mm.
So interestingly, it's a really strong business model. It's proven to work amongst the markets around the world. But I think if you're going to play that space, Zipco is the way to go because they've just launched into the actual physical payment space. They've got diversification of earnings. They're not just buy now, pay later, and they're kind of encompassing that whole financial services product sphere. They're not just a simple buy now, pay later product. So I think we're seeing Klarna having a bad run. I think it's kind of a measure of the times, what's going on in consumer sentiment, where spending is going. We're in a high cost of living environment right now. So a lot of people are using these services, but with rate cuts on the horizon, they might not be as wanted for the buy now, pay later services. So it kind of goes with the economic cycle. So I think expansion of and diversification of earnings is crucial in this space, not just being a niche buy now, pay later service provider like Klarna is. So I think Zipco is the way to go if you're going to play that space.
Okay. I asked you to think about defensive because there
Mhm.
would be a lot of people saying, well, look, the last couple of years I've made really good money.
Yeah.
I'd like to go from maybe a 80 or even a 90% exposure to the market and become a little bit more defensive.
Yeah.
What are the defensive names you really like?
Yeah, I like it's kind of a stable earnings growth in this one, but it's Telstra. Telstra has just announced last week their increase in prices, which for consumers like you and I, we hate it, but for investors, it's great because it ensures profit margin expansion. They are the leading provider in Australia. Vodafone obviously trying to come out recently and say they're lying in their product and their announcements, but I don't think that was the case. And Telstra has been and always will be the number one provider in Australia. They have really stable earnings. They pay a dividend, and that's something that's really defensive about the company. You have to pay your phone bill no matter what, no matter what part of the economic cycle we're in. So Telstra definitely bodes well and holds up in these tough economic times. And with a price increase on the horizon, that means more profitability for a company like Telstra. CSL as well is a defensive one we're talking about. I'm sure we'll get to that a little bit later, but that's one we've seen investors invest in lately and looking at more broadly for what they're doing in the future. Coles and Woolies defensive stocks that we like as well. Obviously, during a tough economic environment, you still have to eat and you still have to buy your groceries. So I think Coles more than Woolies at the moment. We have a hold rating on both to have them. They're good staples for your portfolio. But I just say Coles because they've implemented a $1 billion buy now, or sorry, a simplify and save program to save $1 billion up to the next 2 financial years. So with all the savings and cost savings on the horizon, it shows that their profitability is set to grow over the coming years.
Yeah, I totally agree. Just going back to Telstra for a second,
Yeah.
they've just said that they're going to put the coverage claim back on their website. Just for those people who missed that,
Yeah.
what was the troubling claim they made?
Yeah.
Before you give the answer, I noticed yesterday that Vodafone is now saying they've doubled their coverage in Australia.
Yeah.
But it means it's just double from where they were before. It's not like
Yeah.
okay. That's what I was thinking anyway. But what's this controversial issue?
Yeah, I think Vodafone was saying that Telstra had come out saying they covered X amount more than they actually did. But I don't think you can question that as a company like Vodafone. I'm with Vodafone in my new house I've just moved into. I have no service. So
Yeah.
it's really difficult. I think as a smaller player that anyone's just trying to grab market share from Telstra. And I think Telstra's history, Telstra's stability, and Telstra's product offering is second to none. So with that in mind, and obviously Vodafone's using that at a time to kind of bring themselves up and boost themselves and say, yeah, we've doubled our service coverage and operation, but they don't operate in my area, so I'm not too happy right now.
You know, and you say on one hand you were giving Vodafone a big thumbs up that you actually are using Vodafone. On the other hand, you then said you weren't getting coverage. So we
I'm
might
not
get
happy.
we might get contact from the PR person. All
Yeah.
right, let's go and look at CSL. I know
Yeah.
I sent you a cryptic question of
Yeah.
what the F with CSL? And I think a lot of people are thinking that this is a great company. I really love CSL. I think the Warren Buffett idea of buying when everyone's fearful. People have been fearful about CSL. I'm kind of expecting eventually we'll wake up one morning and be a great report and the price will start rocketing. What do you think is the big problem for CSL right now?
Yeah, so CSL, we do have a buy rating on CSL at Bell Potter and Bell Financial Group, but the thing that's going on at the moment is the Securus brand and V4 Pharma brand, so two of the three revenue drivers, are underperforming market expectations. Securus is a vaccinations brand and or division of the company, and everyone, like we've just seen in America especially, a real drop off in vaccination, in people wanting to get vaccinations since COVID-19. So that weighs on revenues for the Securus brand of CSL. The company is V4 Pharma business we spoke about earlier. That is underperforming as well. Markets expected that takeover to be really appreciative to the growth potential of CSL, and it just hasn't come through since that did take over, and it has been underperforming market expectations. So those two are likely weighing on the outlook at the moment. But the Behring business is a immunoglobulin, the medical, it's the plasma business of the company. So that's their main revenue driver, and that is continuing to do all the heavy lifting for CSL. It's going from strength to strength, and we're seeing strong growth potential for the company as demand grows around the world. And they're a massive company. They've proven capital deployment over 25 years. They've got really attractive returns. So I don't see why the share price doesn't reflect the strength of the Behring business, but I do understand why investors would be a little bit concerned about the underperformance of the other two revenue drivers.
Okay, that's the CSL. One final thing before we go, what is the stock you really think, like for example, one stock that I was the number of stocks in my stable that I think, all the analysts love it. So I think,
Yeah.
okay, I'll hang on to this one. One is Tyro, another
Yeah.
one is Megaport, another one is Ordinate. I think all three companies are pretty good companies, but I think in the case of Tyro, I think it needs more interest rate cuts before the
Yeah.
market gets. And I also think that there's some smarties playing Tyro between about 78 and 90, and they sell off, and they're making good money.
Yeah.
But the people who bought in $1.50 or $2 are praying for that $1.60
Yeah.
takeover price to come back.
Yeah.
You have a view on any of those sort of companies just before you go?
I have a company that I have wanted to buy into for quite some time, and it's ResMed. I know I've covered this story very strong and very closely, and I think that the market oversell on the basis of the weight loss drugs and products was way oversold, because ResMed not only has gone from strength to strength in sales, but they've actually launched a partnership with these weight loss drugs to say, here's a complimentary service with the weight loss injection. So it was the most strategic thing. I sat in on the investor call with the results in February, I think it was, and it was simply amazing. The CEO, the company, the management team, love everything about it. I just want to see the price come back so I can get in.
Okay, that's right. That might not happen.
Yeah.
Grady, thanks for joining us. See you in a few weeks' time.
Thanks so much for having me.
And that's Grady Wolf of Bell Direct. Now, Paul Rickard's coming up, and I want to ask Paul about the bond market and Trump, and also what he's seeing in this super tax. Should people with 3 million plus think about reducing their balance before this potential tax becomes a reality? All right, Paul, thanks for joining us.
Thank you, Peter.
I do want to talk to you about the super tax, but you've also been a bond market player, and you're always interested in what the bond market's doing. And Trump has once again, and I used the line in Soto's Switzer report, he's gone from being a de-escalator to becoming a re-escalator of anxiety around tariffs with the EU 50% threat. And apparently today he's backed off a bit on that. We'll give him some time for the EU to come and negotiate more nicely, as he would put it. What's the bond market telling you about Trump?
Well, the bond market's still pretty concerned, Pete. We've seen quite a rise again last week in US government yields. So that the trigger point initially was Moody's downgrading, but that probably didn't mean too much.
It was a degrading a long time coming.
It's been a long time coming. But I think what you're also seeing is he got his budget bill through. But House of Reps, yep. 214 to 213, I think it was, or it might have been 215 to 214. It was by one vote.
Again, can I ask this question? Because people might be asking, is this the bill that will take away tax on tips?
I think it partly takes away tax on tips, but I think it's grandfathered. Like, that's not grandfathered. I think it's only for a few years, but I don't understand that. We don't get enough detailed reporting.
The big, beautiful bill.
The big, beautiful bill. Yeah. But, that's got the bond market concerned, because that does nothing in terms of addressing the budget deficit, which just keeps on going up. And then you've also just got the sort of ongoing uncertainty in terms of what really are the key policies Are we sort of in stagflation? Is growth going to come back again? And I think the bond market is now putting quite a premium on US government debt. In other words, saying we want to be paid more, that is, means higher interest, in order to fund this big US government deficit. So I think the bond market, just as it was a break in terms of post-Liberation Day, it's not quite the break at the moment, but if things go a bit more haywire over in the US, the bond market's going to get rattled, and that could be the next sort of major handbrake he has to deal with. So watch the space. 10-year bonds at the moment about 4.5%. The 30-year is just over 5%. And while Australia's a little immune from this, global bond markets are correlated, and we've got our own sort of forces of interest rates coming down here, but long rates here can go up as well, particularly if the US market gets skittish.
Yeah, but also, Paul, and this is something I'm just throwing in there. Like historically, because the US market was seen as more reliable and safe and whatever, if their rates went up, it's highly likely we could. But there is a bit of an unusual move that money's coming out of the US and looking for other destinations. So we would be getting a bit of that money, wouldn't we?
I think there has been a bit of uncoupling.
Yeah.
Or decoupling, whatever the word is.
Yeah, decoupling.
I like
uncoupling.
We'll go with that. Decouple. All right. Yeah, I think there's a bit of that, but it's still, it still is the benchmark.
Yeah.
And so this might be losing its status as the benchmark. If that's sort of what's happening, that could take a long, long time, but it is still the benchmark. And so I think you just got to be wary. And I think it'll be a break on the US equity. So if bond rates go up, US stock market will stop rising, because we'll go through what we saw a few years ago when people start to look at valuations again, and a key component of the valuation formula is the US government bond yield.
Yeah.
And so what that means, if bond yields go up, valuations come down, stock market prices will follow too.
Yeah. I mentioned this with Grady, but I've got to run with it again. You got to hope that the takeover theory Trump always chickens.
Yeah, look,
you hope that works again.
You can see where he came from there, because there's certainly a bit in that.
Yeah, okay. Let's go to one where we hope Jim Chalmers chickens.
Yeah,
out.
we do.
And that's with the super tax.
Yeah, look, I mean, the main thing, but there's two things to bear in mind with the super tax, or three things. First of all, it only applies to balances over $3 million. Yep. Okay. There's talk about, maybe the Greens wanting $2 million, maybe it gets indexed, but it's only $3 million, right? So the first question, if your balance is not going to be $3 million on the 30th of June, 2026, don't worry about it, right?
Yeah. But don't turn off.
Don't turn off.
We won't make this boring. This will be interesting.
Secondly, the only tax is only effective on a bit above that.
Yeah.
So this is not changing how the first $3 million is taxed.
Yeah.
And so it's only the bit above that. So effectively, if you've got a fund of $4 million and you're $1 million over the threshold, this is only going to apply effectively to a quarter of your fund, all right? Yeah. Not 100%, not 75%.
It's 1 over 4.
1 over 4. Yeah,
for those people who have mathematical issues.
And thirdly, there are a couple of things you can do to, if you want to think about whether you want the tax to apply.
Yeah.
And maybe I should run and the last thing I should say, Pete, before I go through some of those strategies, is just to say that, of course, the legislation is not yet law.
Yeah.
And won't go back to the Senate till late July at the earliest. And who knows what could actually happen in the Senate, or more importantly, there's a lot of pressure coming from a whole lot of different people. Yeah. And, governments, when lots of noise happens, sometimes they just bend a little bit. So I think there's quite a way to play out on this legislation.
Okay. Well, we won't get into mathematics, but just quickly, let me run through, and you can tell me what you sort of, should people think about pulling money down? So the 4 million person, pull a 1.1 out, so you're at 2.9 million.
Yep. Okay, so that's strategy number one. If you've got, say, $4 million in super, strategy number one is to take $1 million out of super.
Yeah.
Now, first of all, you can only do that because it's super if you've met a condition of release, right? Which for most people is going to be turn 65.
Or you're 60 and totally retired.
Yeah, okay. Yeah. So if you're 49 and working and got $4 million in super, bad luck, you can't do anything about it, right?
Yep.
So this strategy, that's not going to work for you.
Yep.
Secondly, should you do it? Look, I'm probably of the opinion you shouldn't, but if you've got a lot of illiquid assets, for example, let's say you've got your business property, you might be worth a couple of $1 million as part of that.
Yeah.
There's going to be some issues in terms of the calculation of the tax on that, particularly if you want to then pay the tax. But
what do you have to do?
well, you will have to pay it, right?
Yeah,
so it may be some pluses in doing that. If you were $3.1 million, I probably would pull it out.
Yeah.
But what you got to think through with this is that even in its worst case, you're only paying tax at 30% on your marginal dollar in superannuation. Now, unless you can find a lower tax rate somewhere else, super is going to remain a pretty attractive asset from a tax point of view.
Yeah.
Now, there are some issues around the payment of this tax and the timing, and this is to do with the unrealized gain. It doesn't mean you pay extra tax; just means you've got to find the money.
Yeah.
And so the second strategy is one is to take some money out. The second strategy is actually to make your assets a bit more stable in superannuation so that you won't have big unrealized gains.
Yeah, so you're getting defensive income type products.
You get more defensive in super, so you have more things like bonds and term deposits and private credit funds and maybe utility style companies.
Well, even income funds, because they can go down in value, but you still get income.
Income funds, and so you don't get these huge movements in terms of unrealized gains.
Yeah.
Now that means you've got to then either sell your sort of so-called growth assets, but you might put them back into a family trust or even hold them personally, depending on your tax status, right? Yeah. So strategy number 2 is you sort of hold less growthy assets in super. You hold your growth assets outside super, right? Yeah. So that's the second strategy. The third one, Peter, of course, if you can, and you've got your spouse, if you haven't done so already, it's basic super strategy is to try to even out your balances a bit. Yeah. Right.
So you're both under, if you got, say it's 4 million and you're 3 and your partner's 1, give that your partner 1 and they're both on 2.
And the key thing here is you've got to be able to take money out of super potentially, and your partner's got to be able to put my super money back into super. But that's basically a no-brainer. If you see a financial planner, everyone will tell you these days, even out your balances in super as long as you can, right? Yeah. And the fourth thing, and I think for many people, is do nothing. And personally, look, I'm happy to say I'm in that category of over $3 million, Peter. Yeah. I'm not bragging. I'm just telling you what it is.
No, I'm always bragging you that you've got Commonwealth Bank shares that makes you unpredictably wealthy. But we get that.
But that's not the reason. I think you probably would say wait to see until it gets passed. There is time, and I don't know whether unless you've got all my assets are pretty liquid. So unless I had a lot of illiquid assets like a business property or farm or maybe artwork or something else I can't sell of, I think then you've got to think hard about your stuff in super. But I reckon for most people, my advice would be just to wait, see the legislation, get it up and done, and then talk closely to your accountant and your financial planner or whoever you got about the strategy. But super, that all said, a 30% tax rate is hard to beat as an investment vehicle.
Yeah. Yeah. Well, I think, Paul, is one...
and that's the worst case. That's on the worst dollar in your super fund, effectively.
I think there's going to be a lot of people who will say, I'm just going to make my house worth a lot more, either buy a more expensive house and renovate your existing one, take money out of super because that's capital gains tax free.
And that's one of the strategies, Pete. I didn't cover that off, but of course, that's the main...
A lot of people do that.
One of the tax minimisation or very legitimate tax minimisation strategies.
Yeah, if you want to get Paul's full views on this, you have to be a subscriber to the Switzer report. Pretty measly outlay for some fantastic observations.
Could save you millions.
No,
billions. Let's talk about it.
Last year was billions.
It's billions.
Okay, thanks, Paul.
And that's Paul Rickard of the Switzer Report. Thanks for joining us. Don't forget, if you want to get that kind of inside information that Paul's got on the super tax, you're going to need to be a subscriber to the Switzer Report. Please go to switzerreport.com.au. For the rest of you, I'll see you next week. Have a great week, and I'll see you then.